Most people know they should be investing, yet millions never begin. Not because investing is difficult, but because they are overwhelmed by choices. Which account should you open? Which fund should you buy? How much money do you need to start? In this video, I will show you a simple step-by-step portfolio system designed specifically for UK investors. By the end, you will know exactly how to build your first investment portfolio, where to hold it, what to invest in, and how to automate the process so your wealth can grow consistently over time. Before investing a single pound, you need to understand what an investment portfolio actually is. A portfolio is simply a collection of investments working together toward a financial goal. Many beginners imagine a portfolio as something complicated that only wealthy investors possess. In reality, a portfolio can be incredibly simple. Its purpose is to grow wealth while reducing unnecessary risk through diversification. Diversification means spreading your money across many companies, industries, and countries, rather than relying on a few individual investments. Modern investing allows you to achieve this with a single fund that already contains thousands of companies. The goal is not complexity. The goal is ownership of productive businesses around the world. A portfolio succeeds because of consistency and time, not because it looks sophisticated. A successful portfolio should be built on a stable financial foundation. Before investing, ensure you have an emergency fund that can cover unexpected expenses such as car repairs, job loss, or urgent household costs. Investing money that may be needed in the next few years creates unnecessary pressure and increases the risk of withdrawing during market declines. Most financial planners recommend keeping several months of essential expenses in an easily accessible savings account before committing money to long-term investments. This foundation allows your portfolio to remain untouched during periods of uncertainty. Investing works best when money is given time to compound over decades. Stability comes first. Once your financial foundation is secure, investing becomes a much more effective and sustainable long-term strategy. One of the most important decisions a UK investor makes is choosing the correct account. The account determines how much tax you pay on investment gains and income. For most beginners, the stocks and shares ISA should be the first choice. Investments held inside an ISA can grow free from capital gains tax and dividend tax, making it one of the most powerful wealth-building tools available in the UK. Pensions, such as workplace pensions and SIPPs, also offer valuable tax advantages, but are designed primarily for retirement. General investment accounts provide flexibility, but lack tax protection. Understanding these account wrappers is essential because tax efficiency can significantly improve long-term returns. For most new investors, opening a stocks and shares ISA is the logical starting point. After choosing your account type, you need a platform to hold your investments. Investment platforms, often called brokers, allow you to buy funds, ETFs, and other investments. Beginners frequently spend too much time comparing platforms instead of starting. The most important factors are regulation, fees, ease of use, and investment options. Platforms regulated by the Financial Conduct Authority provide an important level of oversight and protection. Whether you choose Vanguard, Invest Engine, Trading 212, or Hargreaves Lansdown, the key objective remains the same. Open the account and begin investing. A slightly lower fee may help over time, but no fee difference can compensate for years spent delaying action. Consistent investing matters far more than finding the perfect platform. The biggest question most beginners ask is what they should actually invest in. For many people, a broad global index fund provides the simplest and most effective solution. An index fund tracks a market index and automatically owns shares in hundreds or thousands of companies. Instead of attempting to identify winning stocks, you own a small portion of businesses across multiple countries and industries. This approach provides diversification, reduces company-specific risk, and requires very little maintenance. Decades of evidence show that many active investors fail to outperform broad market indexes over the long term. A global index fund allows you to participate in economic growth worldwide without needing advanced knowledge. Simplicity often delivers better results than unnecessary complexity. Investment success is driven more by behavior than intelligence. The most effective way to build wealth is by investing consistently every month. Rather than waiting for the perfect market conditions, set up an automatic contribution shortly after payday. This process removes emotion from investing decisions and creates discipline without requiring constant effort. Whether you start with £50, £100, or £500 per month, regular contributions gradually build momentum. Automation also reduces the temptation to spend money before it reaches your portfolio. Over time, these contributions purchase investments through both rising and falling markets. This steady approach is often referred to as pound cost averaging. The habit of investing consistently matters far more than predicting short-term market movements. The final step is often the most difficult. Once your portfolio is established, avoid the temptation to constantly monitor or change it. Long-term investing rewards patience. Markets will experience periods of volatility, economic uncertainty, and temporary declines. These events are normal and should not distract you from your strategy. Compounding occurs when investment returns begin generating their own returns, creating a powerful snowball effect over time. The longer your money remains invested, the stronger this effect becomes. Successful investors focus on decades rather than weeks or months. Review your portfolio periodically, but avoid reacting to short-term headlines. Wealth is rarely built through frequent trading. It is usually built through disciplined investing, patience, and consistency over many years. One of the biggest advantages a beginner has is the ability to avoid the mistakes that cost many investors years of progress. The most common mistake is trying to get rich quickly by chasing trends, hot stocks, or investments that promise unusually high returns. Another mistake is constantly buying and selling based on news headlines or short-term market movements. Many people also delay investing because they believe they need more knowledge before starting. In reality, a simple diversified portfolio is often more effective than a complicated strategy. Avoid emotional decisions, stay focused on long-term goals, and remember that successful investing is usually boring. Consistency, patience, and discipline will outperform excitement and speculation over time. You now have a complete framework for building your first investment portfolio in the UK. From choosing the right account to selecting a global index fund and automating contributions, the process is far simpler than most people believe. In the next video, I will show you exactly where to invest your first money, step by step, including specific fund options and how to set everything up correctly.